Hello, and welcome to the preview of the May issue of The Banker. I am Joy Macknight, Managing Editor, and I'm joined by Kat Van Hoof, Investment Banking and Capital Markets Editor. This month's cover story takes a closer look at the big tech unicorn listings taking the market by storm. Kat, thanks so much for joining us today.
Hello.
So tell me a little bit about what's happening. We have recently Lyft, Pinterest, Slack has gone to the market with their initial public offerings, and Uber is also coming to market. Why are they all coming to market now?
Well, as usual, it's a bit of a confluence of different things. So these companies have been have actually been around for quite a long time now. We use these apps every day, and they've done really large private funding rounds. So they've gotten to a stage in the life cycle where an exit is sort of the next logical and sometimes only step because they're too big for another round. But there's also a little bit of a function of the market where things are still a bit benign. Monetary policy is still very supportive, but maybe a year or two down the line, things starting to look a bit more shaky. So if you want to do a bit more of a risky IPO for a high growth public offering like this, now is probably a good time to be looking at this rather than a little bit further down the line.
Okay, but Lyft was the first one to go, and it hasn't done that well in the aftermarkets. You know, what does that signal for the ones coming through?
So normally when you have a couple of IPOs in the same sector and one of them goes first and doesn't do very well, it usually puts a bit of a damper on the rest of the listings down the line. Well, in this case, it wasn't quite so straightforward. Lyft didn't do very well. It popped on the first day. It listed a little bit above its initial price range and then popped on the first couple of days, but sort of since then hasn't been doing very well. But then Pinterest listed a couple of weeks later and has been doing a little bit better. So normally I would say it's not a good signal, especially for Uber, which is in the same sector. It's also a ride-hailing company. But it's hard to tell because sometimes it can be the case that investors just don't really like Lyft but might like Uber, or it can be a bigger signal of them not really feeling all that confident about this type of IPO. And there are a few questions about sort of the sustainability of their business models, which are definitely making things a bit harder for these IPOs.
Well, that is a big problem, isn't it? Because none of these companies are really profitable in the big sense. You know, what challenges does that pose in investors in these companies?
So the profitability is a big thing, and usually if a company has a lot of structural growth, investors are happy to overlook a lack of profitability. But there are a lot of questions being asked. You know, these companies aren't like Google that listed very early on in their life cycle. They are listing as more mature companies and still haven't quite gotten over that profitability hurdle. There's a lot of questions being asked about the revenues growing exponentially, but also the losses deepening because the costs are still very high. There's a lot of money being thrown at sales and marketing. So long as there's growth, I think investors will be happy with it. But once you list, that pressure to turn that profit is going to be definitely doubling down for these companies. So alongside a few other red flags, this is definitely one of the major concerns.
Well, another red flag is really around governance. You know, how much is that making an impact on how successful these IPOs will be?
Yeah, governance is a massive theme in investment, and it's only going to get bigger. It's only, it's a one-way street. It's not coming back. By its nature, there's a lot of key man risk. We say key man because there's a lot of the CEOs tend to be men, but there's a lot of key man risk here by its nature, where it's run by a very charismatic, often entrepreneur, a set of entrepreneurs. And while that is great to get VC, venture capital funding, private funding, it might not be sometimes to have this great personality cult. It might not be the right thing for a big listed company to have the sort of combative or sometimes abrasive manner. And then on the other hand, a lot of these companies, Lyft for instance, are listing with dual class shares, which means that they are selling shares but not the equal amount of voting rights. So the entrepreneurs retain a lot of the control. So this can be helpful because sometimes investors, shareholders don't always understand the companies as well, but also it poses a great risk in case something goes wrong. Shareholders have a lot fewer tools at their disposal to call the entrepreneurs to account, essentially.
Excellent. Well, thank you so much for your insights. To get a copy of the May issue of The Banker, please go to thebanker.com.